All right, wonderful. All right, so let's restart. Thanks again, guys, for coming back from lunch and the wonderful presentation by Doug Breeden. And if anybody at the conference has any questions, you can put them in Q&A or chat or both, and we will read them after Daryl finishes his presentation, or you can just put like a thumb up on the screen so we can see it and ask you questions. All right, so quick introduction. Well, I guess not so quick since so many accolades. Daryl Duffie is the Adams Distinguished Professor of Management and Finance and also Economics, right, at Stanford Business School and Stanford University. So this is kind of professor to the power of 3. Daryl Duffie's research interests include over-the-counter markets, banking, financial stability, credit risk valuation, and hedging of derivative securities, financial market infrastructure, term structure of interest rates, financial innovation, security design, market design, and fintech payments. So pretty much everything since Black-Scholes model was found 50 years ago, he has contributed to all other parts of finance, including derivatives. Daryl Duffie has actually several books, including How Big Banks Fail, Measuring Corporate Default Risk, and Dark Markets. He was awarded the Stephen Ross Prize in Financial Economics in both actually 2014 and 2021, and Amundi Pioneer Prize in 2017. He was named the IAFE SunGard Financial Engineer of the Year in 2003, exactly 20 years ago. He is a fellow and member of a Council of Econometric Society, research at NBR, and a fellow of the American Academy of Arts and Sciences. Daryl Duffie was also the president of AFA in 2009. He also chaired the Market Participants Group, chaired by the Financial Stability Board, and that was around 2014, and he actually recommended reforms to LIBOR, Euribor, and other interest rate benchmarks, which were actually changed subsequently to his research and his presentations. I personally actually see Daryl Duffie at all important meetings of the finance associations such as NBR, AFA, Federal Reserve Board, OFR, and so on. And some of the kind of recent topics of his interest and research and the policy impact actually have huge policy impact. Implications are economics of digital currency, stability of CCPs, resilience of the US Treasury markets, and so on. And personally, he's very kind of friendly, very clear presentations and suggestions to my own papers, miraculously transformed them from a kind of convoluted mess to a cogent argument and clear thought process with led to publication. So thank you very much. Personal thank you. And it's a pleasure to introduce Professor Daryl Duffie, who will present his work on dealer capacity and US Treasury market functionality. Thank you very much again. Thank you.
Mila, I don't know what to say about this introduction. I feel embarrassed. Your research has had a big influence on me. But we're here today to talk about or to honor the Black-Merton-Scholes option pricing revolution in financial markets. I'm going to talk Sanjay suggested I could talk about something not necessarily related to options per se, but I am going to talk about market structure. And so I'm going to say a few things about option market structure in relation to my discussion today about Treasury market structure. Before I do that, I want to say what an honor it is to be able to speak in honor of the Black-Merton-Scholes contributions to option pricing. Of course, I knew Fisher Black, and I know Bob Merton and Myron Scholes very well. They're dear friends. And I get to speak with them, especially Myron, because he's my colleague here at Stanford. When they won the Nobel Prize, the Nobel Committee asked me to write an essay published in the Scandinavian Journal of Economics describing the contribution. And in the course of doing that, I gained an even deeper sense of appreciation of the importance of their contribution. Now, let me jump into the a little bit on the topic of market structure. I'm going to describe in a moment the need for an evolution in the market structure for US Treasury securities, which is entirely dealer intermediated. And when I do that, I'm going to bring up possibilities for all-to-all trade in the Treasuries market. This brings us back to 1973, when the famous paper was published by Black-Scholes. Something else very important happened to option markets that year. In that year, the market made a transition from entirely over-the-counter dealer intermediated market to the entrance of the Chicago Board Options Exchange. That revolutionized option markets as well. And the growth of the market since then has been spectacular. I looked at the numbers this morning just of the cleared portion of the options market. In 1973, roughly 1 million contracts were traded. Last year, roughly 10 billion contracts were traded. So a factor of 10,000 growth. Indeed, in the very first month of operation of the Chicago Board Options Exchange, more options were traded than in any prior year in the dealer intermediated over-the-counter market. So the introduction of an exchange can have a massive effect on the liquidity and volumes in a market. The problem is that the Black-Merton-Scholes breakthrough in option pricing also had a spectacular effect in the demand to trade options. And it's pretty hard, as I sit here today, to disentangle how much of the growth in that market is due to that famous paper and how much is it due to the advent of all-to-all trade. But there's no doubt that formula and the method by which it was shown was revolutionary for financial markets in not just options markets. Now, having said that, let me turn to the issue of market structure in the US Treasury market, and I'm going to share my screen. One moment. Let's see if this works. Do you see my screen, Mila?
Not yet.
Not yet? Okay, let's go back and try this again.
Yeah, no.
Okay, hang on. I'll get it right this time.
Right.
Okay.
Yes.
Now you should see it, and I'm going to go to full screen. No. Okay, I think we finally got it.
Yes, thank you.
Okay, so I'm going to focus my remarks on the capacity of the current market structure for US Treasury securities and how it's limited, how the market structure limits its capacity. And this is based on joint work that I did when I was on sabbatical at the New York Fed last year with Michael Fleming, Frank Keene, Claire Nelson, Or Shakar, and Peter Van Tassel. And needless to say, any views that I offer are not necessarily those of the Federal Reserve Bank of New York or the Federal Reserve System. And in fact, I'm going to offer some opinions near the end that may or may not coincide with the views of all of my co-authors. I want to give my personal sense of how to improve the US Treasury market structure. What is that structure? It's an entirely dealer intermediated market, meaning if you are an investor represented by a blue dot in this diagram, and you want to buy or sell Treasury securities, you can only do that through a dealer, which is represented by a green dot. So D1, for example, might be JP Morgan, D2 might be Goldman Sachs, and so on. And if you're a pension fund, an insurance company, a mutual fund, a foreign central bank, a sovereign wealth fund, or any kind of investor, you will be buying and selling from dealers in the US Treasury market. You can do it directly in a bilateral way, as indicated in the diagram, like C1 could call for D1 for quotes, or you could launch, as C3 might do, a request for quotes on a multilateral trade platform. And there are various types of such trade platforms in the market, like Bloomberg, for example. The dealers, on the other hand, have access to both bilateral trade with each other and a central limit order book market called BrokerTech, at which they can post limit orders and execute market orders with each other. The blue dots don't trade on that central limit order book. Why is this market structure limiting the US Treasury market? It's because these green dots do not have unlimited capacity to handle volumes from their customers. And when markets become extremely active, the green dots can be overwhelmed by volume. There's no way for the blue dots to trade directly with each other, and the market can actually become dysfunctional. Let me give you some more details on that. And Mila, if I start to go over time, maybe give me a 5-minute warning at 45 past the hour, so that we have plenty of time for Q&A. This diagram shows the schematic that I just gave you on the left-hand side. And on the right-hand side, you'll see evidence, the first evidence of the fact that the Treasury market is becoming very big for these dealers to manage. The vertical axis on this chart is the ratio of the amount of Treasuries outstanding to the total size of the balance sheets of all primary dealers. You can see a pattern. Before the financial crisis in 2008, dealer capacity was increasing relative to the size of the US Treasury market. And after the financial crisis, the Treasury market began to overwhelm the growth of dealer balance sheets for two reasons. Number one, the financial crisis taught regulators that they needed to regulate the capital requirements of those primary dealers much more actively, and that limited the incentive of those balance sheets to grow, and also limited their flexibility for handling volume. Now, that was a good idea to regulate them because we don't want another financial crisis. We want financial stability. But it has limited the growth of those balance sheets. The other reason that the blue bars climb so rapidly on the right-hand side of this chart is that the volume of US Treasury securities has been growing by leaps and bounds. It's now about 25 trillion. It was around 8 trillion at the financial crisis, and it's projected to be about 46 trillion in the mid-2030s. So this market is getting very large, and the dealers' balance sheets are not getting very large. They're roughly not even growing with GDP. In fact, over the last 10 years, dealer balance sheets have grown slower than GDP, whereas US fiscal deficits have blown up the US debt to GDP ratio enormously. The debt to GDP ratio is projected to reach 150% by the Congressional Budget Office by the year 2050. This trend is unsustainable. This market structure shown on the left-hand side is not capable of handling volumes of trade on an extremely active day if the market continues to get larger and larger. And I'm going to use the events of the COVID crisis of March 2020 to illustrate that. The horizontal axis in this diagram are dates in 2020. The vertical axis is the increase in spreads in the interdealer market for not only US Treasuries, but also for gilts and bunds. And you can see that the spreads widened out very dramatically by a factor of around 2.5 in the Treasury market and around 4 in the gilts market in mid-March of 2020. On March 12th of 2020, the World Health Organization declared COVID to be a global pandemic, and investors all over the world began to sell treasuries and go to cash for a number of reasons. Foreign central banks were looking for cash because their own banks needed US dollars to meet rollover needs in the dollar funding markets and to defend their foreign currency prices. Hedge funds liquidated positions because of increases in volatility and unwinding of large arbitrage trades, including basis trades. Mutual funds liquidated treasuries because their shareholders were sending in large redemption requests and they needed liquidity to meet those requests. All over the world, investors were relying on the US Treasury market as a source of liquidity. That's one aspect of its safe haven services, that it's able to provide liquidity. But you can see in this diagram that liquidity deteriorated significantly in the interdealer market. And on this slide, you can see on the vertical axis the increase in bid-offer spreads in the dealer-to-customer market from Bloomberg data. This slide is from a presentation by Lori Logan, who was the system open market account manager at the New York Fed at that time. She's now the president of the Dallas Fed. The chart shows that until March of 2020, bid-offer spreads were very stable. They're indexed here to 100 at the beginning of the year. But in March of 2020, bid-offer spreads blew out by a factor of over 10 and eventually came back down. Why? Because the Fed stepped in order to improve liquidity in the market. What did the Fed do? It bought Treasury securities from dealers so that they would have more space on their balance sheets to intermediate customer trade. The Fed purchased over or around $1 trillion of Treasury securities in the first 3 weeks after mid-March. That was necessary because as investors all over the world sold treasuries to dealers, the dealer balance sheets were getting filled up and they couldn't handle more, and they rationed investors by increasing bid-offer spreads. In the interdealer market for US Treasury securities, BrokerTech, on the vertical axis, you can see market depth in millions of US dollars. So the black line at the top shows that in early 2020, a dealer could get up to $180 million executed at the best 3 ticks on the limit order book market at BrokerTech. So depth was about 180 million leading into the COVID pandemic. Once the World Health Organization declared global pandemic on March 12th, the depth had almost disappeared to around 10 million, eventually recovering. This is from a slide prepared by strategy experts at JP Morgan. So both in the interdealer and the customer market, liquidity had deteriorated dramatically. And the main reason, again, is that dealer balance sheets were overflowing with inventory and they couldn't handle any more risk. I'm going to document that more carefully with data from obtained by the New York Fed from confidential government sources in the next few minutes. And I'm looking forward, by the way, to any questions in the last 15 minutes that we have together today. So start saving up your questions. On the right-hand chart of this figure, you can see the amounts purchased by the Fed that I just described in the first 3 weeks alone, approaching $1 trillion and then continuing. The Fed also offered unlimited financing to dealers through the repo market, and they also relaxed one of the key capital requirements for US Treasuries and for Federal Reserve deposits, called the supplementary leverage ratio, in order to make more space on dealer balance sheets. On the left-hand chart, you can see that the European Central Bank was also very active. It had been making quantitative easing purchases, but in the spring of 2020, when COVID hit, it started to make enormous pandemic purchases. The Bank of England was similarly active. Each of these three central banks bought on the order of 10 to 15% of GDP worth of government securities. This particular chart shows on the vertical axis the bid-ask spreads indexed to 1 on March 18th, how they increased to a factor of approaching 2 by mid-March, and then with the purchases by the Bank of England in the gilt market, bid-offer spreads began to be reduced again. This is in the interdealer market. Remember, in the customer-to-dealer market, bid-offer spreads increased by a much larger factor. This chart is from a paper at the Bank of England by the authors shown in the footnote. So now getting to the data that we collected and analyzed in the work that I'm describing today. This work was done again at the New York Fed over the past year. We collected data across 3 different maturity segments of the US Treasury market, short, medium, and long, if you like. The 2-year sector, the 5-year sector, and the 10-year sector. And we collected data in each of those sectors bearing on various notions of illiquidity. So on the left-hand group of colored bars in this diagram, you can see price impact. So we collected price impact metrics. We collected bid-ask spread metrics. We collected market depth metrics on BrokerTec, and because we're measuring illiquidity, we took minus the logarithm of depth. We collected data bearing on the noisiness of the Treasury yield curve. When the Treasury yield curve is very smooth, that means arbitrage is working well and markets are liquid. When the Treasury yield curve has a shape that's very rough or noisy, as shown by a paper by Drin Pan and collaborators, then that's a sign that the markets are very illiquid. We also measured price dispersion. That's we developed a measure of price dispersion showing how the same security at the same time of day was trading at 2 different prices because markets were very illiquid. So price dispersion is basically the standard deviation of cross-sectional variation of prices at a given point in time. The law of one price was failing in the US Treasury market because some dealers were better able to offer good prices to their customers than were other dealers, a sign of market illiquidity. And then we looked at the illiquidity measure known as the on-the-run premium, meaning off-the-run securities are less liquid than on-the-runs. The older issues of US Treasuries trade at a spread to the newest issues called the on-the-runs, and that spread is a measure of market liquidity. When that spread is very high, that means markets are very illiquid. So altogether, you can see we have 18 different metrics, 3 maturity segments, and 6 measures of illiquidity in each segment. We constructed one measure of illiquidity because analyzing 18 metrics is quite a lot for one paper. And that one metric that we combined these into was the first principal component. And what you're looking at in this chart is the loadings of these 18 different metrics that show up in the first principal component in data going from mid-2017 into 2023. And you can see the loadings, there's quite a lot of loading on all of these metrics. None of them are dominating the rest. They're all important in measuring illiquidity. So with that one composite measure of illiquidity, I'm now going to turn to what explains illiquidity in the US Treasury market. And the dominant explanation of illiquidity is yield volatility. So this chart shows on the vertical axis the z-scores for illiquidity in bold black and the z-score for swaption implied yield volatility in the other color. I'm colorblind, but I'm guessing it's red. I see this is the first point in the talk that I get to talk about options. So we are using options today. And we're in fact using the Black-Scholes formula to invert swaption prices to get option implied interest rate volatility measured on average at the 2-year, 5-year, and 10-year points. So these are in 1 month for 2 years, in 1 month for 5 years, and in 1 month for 10-year swaption implied vols averaged together. It gives you a very simple relationship. As you can see, illiquidity in the US Treasury market is virtually the same as yield volatility, except for some variation, particularly in March and April of 2020, when the COVID pandemic hit. And then you can see, if you have good eyes, that illiquidity soared to more than 4 standard deviations, nearly 5 standard deviations above its sample mean. Yield volatility also climbed, but not nearly as much. There's something that changed in the relationship between illiquidity and yield volatility when COVID hit and investors all over the world tried to liquidate US Treasuries in enormous quantities. I'm going to turn to that in a minute, but first I want to remark about this close relationship with illiquidity, between illiquidity and volatility. It should be a close relationship most of the time, because after all, the demand for liquidity by investors grows with volatility in markets, more needs to hedge, more needs to get out of positions or enter positions to speculate or invest. And the supply of liquidity by dealers declines with volatility because it's more expensive for dealers to handle inventory when volatility is high. They have value at risk constraints, and they also have agency costs for managing positions when volatility is high. So supply and demand for immediacy in the Treasury market means that illiquidity and volatility should have a close relationship. Let's look at it in a regression sense. On the horizontal axis of this diagram is the same measure of yield volatility implied by options on swaps. And on the vertical axis is the same measure of US Treasury illiquidity. But now instead of showing you the time series, I'm showing you a scatter plot of daily observations. There are 1,331 days, and you can see a very regular relationship most of the time between illiquidity and volatility. In fact, that relationship was allowed to be quadratic in this regression because we're including squared volatility as an explanatory variable for illiquidity. But remarkably, the relationship is almost linear. The R squared for this relationship is about 80%. It's extremely regular, but we're going to focus on the outliers. Those are mostly the little red squares that correspond to dates in March of 2020. You can see that those outliers are mostly from the COVID shock, and they're very large. Why is that? It's because dealer capacity for handling volumes in this market was getting used up significantly in March of 2020 as investors all over the world called dealers and asked dealers to absorb their positions. The vertical axis of this chart shows capacity utilization measured as a fraction of the estimated maximum possible intermediation capacity of dealers. That's a complicated calculation that we can come back to in Q&A. The horizontal axis is time, and capacity utilization is measured with various different metrics. One is the gross positions of dealers, that is the total of longs plus the total of shorts all of these measures are risk adjusted for both duration and volatility. Another measure of dealer capacity utilization is the volume of trade that dealers handled from customers over the preceding 3 days. We did a robustness check for 2 days and 5 days. Our results are quite robust to varying the lagging period. The lagging period is important because it takes more than 1 day on average for a dealer to buy and then offload a position from a customer. So those positions are going to rest on their balance sheets for a day, 2 days, 3 days, perhaps 4 days or 5 days. And the volume that they've been handling is another measure of how much their balance sheets are getting loaded by demands for liquidity from their customers. A third metric is the net positions handled by dealers rather than the gross position. A fourth metric is dealer to customer gross volume rather than net volume. And not shown on this chart, we also measured value at risk metrics, both for the firm and for the fixed income desks of these firms. We measured all of these, including not only Treasury securities, but also including mortgage-backed securities and corporate bonds, because the same fixed income divisions of these firms are getting loaded at the same time by demands for liquidity in the mortgage-backed securities market and the corporate bond market. It turns out the corporate bond market isn't that important. The agency MBS market is huge and is approaching the importance of the US Treasury market. So one must consider these various segments together in order to understand how loaded the balance sheets are. And you can see they're very loaded in March of 2020 because, as I mentioned, investors all over the world are trying to liquidate their positions. Now let's look on the vertical axis at US Treasury market illiquidity, but we're only going to look at the portion of it that's not explained by volatility. So this is the residual of the regression I showed you earlier. So 2 on the vertical axis means that illiquidity is 2 standard deviations above what volatility would suggest. And you can see that as on the horizontal axis, as the average capacity utilization of dealers climbs above around 40%, illiquidity grows well beyond what would be suggested by volatility alone. It's a highly nonlinear relationship. Below 40%, dealer balance sheets are not that heavily loaded, and the extent to which they're loaded doesn't really have that much effect on illiquidity. But once the balance sheets start getting loaded above 40%, dealers start to quote wider spreads, offer less depth. On average, all of the liquidity metrics that we discussed earlier start to grow as a reflection of the fact that there's less and less space available for dealers to intermediate the market. And this is why the central banks around the world needed to step in and unload those balance sheets by buying directly from dealers so that they could offer more intermediation to their customers. This is a similar reflection of these results using quantile regressions. What we're seeing here is a 99th percentile quantile explanation of illiquidity using various measures, various explanatory variables. So in the first column, for example, if you used univariate regression on dealer gross positions, risk adjusted, you can see that you get a pseudo R-squared of about 69% of the variation is explained, and you can see a high dependence. The variables here are measured in terms of z-scores. So 1.2 means when you increase gross positions by 1 standard deviation, illiquidity climbs by about 1.2 standard deviations. Column 2 does the same for net positions. Column 3 for total capacity to buy from customers over the preceding 3 days. The fourth column is simply option implied volatility. And at the 99th percentile, you can see that while that's a very important variable, it doesn't explain in terms of pseudo R squared any more than simply dealer intermediation capacity. And of course, you can combine volatility and capacity as you get over into columns 5, 6, and 7 and get yet higher explanation. The story is basically that capacity utilization of dealers is very important in explaining the tail levels of illiquidity in the US Treasury market. I'm going to end now with some policy discussion. This is not from that research paper. These are my own views. And I hope that these will trigger some discussion about how to improve the resilience of the US Treasury security market. Treasury market resilience is now a project of the US government. There's an interagency working group consisting of the Securities and Exchange Commission, the US Treasury Department, the Federal Reserve Board, and the New York Fed to improve the resilience of this market. This project was kicked off because of the events of March 2020, revealing that the market can become dysfunctional. And the word dysfunctional was actually used in the official sector to describe that problem. The interagency working report has prepared 2 white papers on diagnosing the problem and potential resolutions of the problem. Here's my set of suggestions. First, and this is described in a research paper with Frank Keene at the New York Fed that I also wrote on my sabbatical while at the New York Fed this year. First, the official sector needs to be prepared to step in and buy from dealers given the current market structure so as to relieve them of inventory when the market gets clogged up, as it did in March 2020 and also during the global financial crisis. Second, the Securities and Exchange Commission has proposed a broad central clearing of the US Treasury market. So the idea here is to improve the safety and soundness of the market and also to increase the efficiency of dealer balance sheets. Because right now, I see Myron has joined. If Myron has just bought 120 million from one customer and he sold 100 million to another customer, then he has gross settlement commitments for 220 million. That's a lot of risk, and Myron might think carefully about whether he wants to do a whole lot more of that. At peak days during the COVID crisis, dealers had overnight commitments to settle in excess of 1 trillion of US Treasury securities transactions. Central clearing was shown in a paper by Frank Keene and Michael Fleming to reduce those settlement commitments to 30% if central clearing were extended throughout the market. And that is what the SEC has proposed. And it's getting very close. It was unanimously agreed as a proposal, and it's getting very close to coming out as a regulation later this fall or early next year. I think this is a very important improvement in market structure. And I hope that this proposal is successfully implemented over the next couple of years, again, to improve safety and soundness and efficiency of the market and to increase its capacity under stress. A third policy for improving US Treasury market resilience is to offer financing through the standing repo facility and through FEMA, which is offered to foreign central banks, because not everybody that needs cash needs to sell their securities. Some of these investors only need cash. They could finance their securities with the New York Fed, and that's what these 2 facilities do. Fourth, surprisingly, we don't have transactions reporting in the US Treasury market. Only the on-the-run trades on BrokerTech and a few snapshots of bids and offers on Bloomberg are giving price transparency. There's no post-trade price transparency available to the public. It's quite shocking because we have this in derivatives markets, including options. We have it in swaps. We have it in equities. We have it in corporate bonds through Trace. But until now, because in my view, the dealers have resisted this, we don't really have any significant amount of transactions reporting in the US Treasury market. If we did, that would improve the efficiency of the market as well. And it would also improve its transparency and resilience. The SEC has also, number 5, proposed to lift exemptions for US Treasuries to fair access provisions on trade platforms. And you might have just done a double take. You mean what? US Treasuries are exempt from fair access? Yes, a long time ago, the government decided to exempt Treasuries from many regulations because they didn't want to gum up the market with too much regulation, given that it was the government's own securities. They didn't seem to be as concerned about private sector securities as Treasury securities. But now the concern is flipped. The government is concerned that now that there's not enough fair access of investors onto trade platforms like BrokerTec, and they're going to lift those exemptions. And finally, there's been proposals, including by the G30 group chaired by Tim Geithner that I contributed to, and many others, to lift or at least relax the leverage ratio rule, which is a capital requirement that really uses up a lot of dealer balance sheet, even for their holdings of central bank deposits or reserves. And that's a needless capital requirement. Central bank deposits cannot go down in market value. There's no need for a capital requirement. Yet, when the central bank steps in to buy treasuries from dealers, they pay for those treasuries with reserves, and they don't really relieve the dealer balance sheets very much in terms of capital requirement, because reserves carry a capital requirement under the leverage ratio rule. So I and others have proposed that the leverage ratio rule either be reduced or eliminated for at least treasuries and reserves, if not more generally. So those are the top 6 on my list, but I'm very interested to hear what everyone else now joining the conversation has in mind, and any reactions or disagreements that you might have with the views that I've offered here. So thank you, Mila. I'm turning it back to you.
Great. Thank you very much. So we have Hossein, Sanjay, and I here. So thank you. This is amazing. So please, guys, there's lots of people here, so you can just speak up or just put question in Q&A or chat. And I will just start off talking about dealer capacity. And specifically, 2 weeks ago, I was at the Federal Reserve Board in Washington, D.C., and there's a 2-day great presentation conference on market structure. And we had Maureen O'Hara actually gave a dinner address, and in there she was also talking about dealer capacity, but from a point of view. So I guess this is a question: where's the limited dealer capacity? Where's it coming from? So the discussions we had there, also given the regulations happening after the recent financial crisis, by recent I mean 2007-08, so not the most recent, we have actually less dealers. So that's, the dealer capacity could be just because there's less dealers, right? That's a point. Another one also, that actually dealers are also less willing to do market making in terms of actually getting paid, and they're just taking too much risk for which they're not paid, so they're becoming in a way glorified brokers. And so there are other reasons kind of for dealer capacity decrease. Could you maybe just discuss kind of what do you think, what are the main reasons, quantities or qualities or per person and so on? Thank you.
Okay, so dealer capacity is limited by a number of factors. One is the amount of risk that dealers want to take on is not unlimited. Firms can fail if they take too much risk. That we know that. This is now the 25th anniversary of LTCM. We learned that markets individual firms can take too much risk. And it's the 15th anniversary of the failure of Lehman. So if you take too much risk, you'll fail. So firms generally try to hold up from taking too much risk. Number 2, they're regulated against taking too much risk. Now, they could issue more shares to increase their capital base, and that would allow them to increase their capacity. But issuing more shares, while it might be good for the market, is not necessarily good for the shareholders. This thing that Stu Myers discovered in 1984 is called debt overhang. What might be a positive trading profit from increasing your capital is not necessarily a positive return for your shareholders. That's a second factor, debt overhang and capital regulations. And the third thing that's limiting dealer capacity is the relative size of their balance sheets to the growth of US Treasury markets outstanding. The Treasury market has grown from 8 trillion at the financial crisis to 25 trillion today. And so dealer balance sheets would have had to grow by a factor of 3 just to keep up with the capacity that they would need to intermediate this enormous market. And rather than growing by a factor of 3, they've barely kept pace with GDP growth. An issue that I emphasized earlier. And going forward, Treasury markets continue to grow by leaps and bounds because of fiscal deficits, whereas dealer balance sheets are not likely to grow even as fast as GDP. So altogether there, though, I think those are the main factors. Maureen O'Hara actually told me that she was going to give a discussion of this issue, and I applaud that. I think it's a really important issue. Is we should all focus on dealer capacity, and we should think about all-to-all trade, because it shouldn't be the case as it is today that if you want to buy or sell treasuries, you can only go to a dealer. There's no all-to-all trade in the treasuries market. There should be at least the possibility of some trade in the all-to-all market. If we had central clearing, a point I mentioned earlier, that would perhaps increase the incentive of trade platform operators to open up the market more broadly, because then they wouldn't be responsible for handling the clearing of trades. They could have a central counterparty like the DTCC manage that. So I would expect if the SEC central clearing proposal were to come into force, that we'll see more all-to-all trade and therefore more intermediation capacity. We won't have to rely 100% on primary dealers to intermediate the market.
Before we go on, I want to welcome Black-Merton-Scholes. He's here on the screen, and we will continue with the questions. So I have a question, Daryl. In his book, Anat Admati, he talks about increasing capital requirements for banks up to maybe 20 to 30%. And I've reflected on this a lot. For greater public good, why banks and these big dealers, anybody who deals with big assets, which are to do with, public debt and those type of things, that public good is involved over there. Why shouldn't there be more regulation just to simply increase capital requirements? I know shareholders are not going to be happy, but so what?
Well, I totally agree with my colleague, Anat Admati. We should have higher capital requirements. I have another colleague, Juliana Beganow, that has a model that quantifies capital requirements at, I think in her paper, it's 16% turns out to be the magic number. Of course, the models are not perfect, but much higher capital requirements, as Anat suggests, would be appropriate and would improve the efficiency of this market, because then it wouldn't be as difficult for dealers to absorb large customer positions if they had more capital. Unfortunately, the largest banks have been reasonably convincing to regulators, although not to others of us, that increasing capital requirements would reduce market liquidity. And I think that's false. There is a question, though, in the transition, in getting from current capital requirements to, say, 20%. It could be that during that transition period, banks might be reluctant to take their balance sheets up in size. They might try to meet the capital requirement by shrinking their balance sheets at the same level, the same dollar amount of capital. And so the transition would need to be managed very carefully. But I have no doubt that once we get to high capital requirements, markets would be much more liquid.
That's great. Yeah,
Great.
I think
Thank you.
might.
Thanks. I have a question actually, just to follow up also on the discussion we had at Federal Reserve Board, and with also Marina Hara, and kind of one of the reasons you mentioned about the Treasury market increased. But I guess the question is also about that recently we have had the increase in interest rates and velocity of it really has increased. So the question is, and I guess maybe this is more speculation question, is do you think, given that, we see the structure of markets is not stable, some things have broken, some might break. Do you see anything that's more likely to break, or something at least that really needs to be rectifying as soon as possible before it breaks? With velocity of interest rates increase, like that has, maybe it increased too fast, that it's like, we're speeding up, we're driving the car sedan at the speed of BMW or Mercedes that wasn't really built for that. Didn't break yet, but it might.
Yeah, my view is that with good regulation and capital regulation and good market structure, that market should be able to handle this volatility. We had much higher volatility in the mid-1980s when Federal Reserve Chair Paul Volcker raised interest rates above 15%. So I don't think it's, it is the case that as interest rates have gone up, they've become more volatile, and banks like Silicon Valley Bank have gone under because they didn't properly hedge their positions and they weren't supervised sufficiently for capital. But those mistakes are not necessary. You can have, if you need to, the Federal Reserve raise interest rates to battle inflation and have a safe and relatively liquid market. Remember, though, as I showed in my chart, as interest rates rise and become more volatile, there's a natural growth of a problem with illiquidity, in that it's economically defensive position for dealers to offer less immediacy to markets when treasuries are more volatile. So that's a natural thing. It's not about market structure. It's about uncertainty of investors regarding monetary policy and U.S. growth rates, and just ability to manage these deficits as a natural economic dampening on market liquidity. That explains, as I mentioned, about 80% of the variation in liquidity is simply interest rate vol. But the most of the remainder is a question of good regulation and good market structure.
Great. Thank you very much.
Meryl?
Okay, Hossein Kazemi has a question. Yeah. Oh,
Meryl,
yeah.
can I ask?
Oh, yeah, go
Oh,
ahead.
yeah, sorry.
Sorry. Hi, Deborah. One in terms of the risk increases, is there a greater premium at the time the risk increases, and therefore the reward would be higher? So I'm thinking about, is there a structure only within the Treasury market to have sort of contingent partners which will come in to supply capital for a limited period of time, as opposed to issuing equity, for example? There are other structures that you've thought about that might work with a higher premium.
You could offer insurance, and you have it to some extent in the swaption market against increased volatility, and we can use your theory, Myron, that we're celebrating today. We could use option pricing theory to measure the risk premium for absorbing the risk that yields will rise above a given level, or absorbing the risk that volatility will rise. And we can do that today in swaptions markets. But despite the fact that the swaptions markets are very deep, there is a risk premium for absorbing that risk, and we wouldn't expect an unlimited amount of investors to absorb that risk. Even if we have willing investors, the market still needs to be intermediated under stress, and that won't simply the availability of investors and the necessary contracts like options is only part of the equation. You need market intermediaries to stand ready to buy and to sell these contracts in order to transfer the risk from those willing to take the risk. From those willing to those willing to take the risk, and that's the missing part of the equation that we're seeing in these periods like March of 2020.
Okay, any more questions? Otherwise, we will take maybe a 3 to 4 minute break before we begin with Myron's keynote speech at 2 p.m. So thank you, Daryl, for coming. That was the most enlightening talk about U.S. Treasuries. So we will then convene shortly at about 2 p.m. Thank you.
Let me also repeat to Myron what I said earlier, that it's an exceptional honor to be here and to celebrate the 50th anniversary of his amazing contributions to science. So thank you, Myron.
Thank you for your participation. Sorry I wasn't here earlier, but I had having some trouble with my shoulder, so I had to figure out how to get it working better. So I appreciate it a lot, Daryl, and you're a wonderful colleague, and I appreciate that as well all these years. So thank you very much for your assistance and your support, and also your contribution to my increase in my mental stimulation, and what you've done in terms of what you provided to the profession as well. Thank you.
Thank you, Myron. I'll see you around the school.
Yeah, for sure.
Perfect, thanks. So let's kind of wait a couple of minutes. Thank
Yeah,
you,
we'll just.
Daryl. Yes, that's great.
So just want to thank you, Myron, for everything, for coming today. And we will just start in about 2-3 minutes. Yeah, just
My pleasure. Actually, I don't know how many people are on the sessions. Do you have a note or something? Or am I talking just you, Sanjay? Or am I talking to the wall? Or
I think you can see it on your screen too. The online participants are about 56 or around there, and there are about 40 people in the room. I think, I don't know, Mila can confirm that. So about 100 people.
Okay, good.
Total.
Yeah. Oh, sorry, I was trying to get in a little earlier, but I've been having some trouble with my rotor calf, and so I had to get it exercised. And before I would try it, but getting old has its benefits because you lived a long time, but it also has its costs. So
Yes. So
No,
yeah,
it's like what you warmed up in terms of physically and mentally, right? Yeah, so we have about 60 participants online, and more I think will come, and we have also the full room here in terms of PhD students, alumni, faculty, and on participants we have pretty much faculty, students from around the world. So everybody who wants to, and this is 9 to 5. So I applaud everybody also for being here and listening. Right. Yes, and definitely thank you. And I also, when I was at the Federal Reserve Board 2 weeks ago, I invited several participants there. So we have people also from regulators as well.
All right, great.
And then I think we will